In February of 1637, a tulip bulb changed hands in Haarlem for a price equivalent to that of a house in central Amsterdam. It wasn't just any tulip. It was a Semper Augustus, a variety with white petals streaked with red, considered the most beautiful of all. But it was still a bulb. An onion that produced a flower. A few weeks later, the market collapsed. Bulbs that had cost fortunes couldn't find a buyer at even a fraction of their previous price. Contracts that had been signed couldn't be fulfilled. Euphoria turned to panic overnight. It was the first documented financial bubble in history. And it wouldn't be the last. From Dutch tulips to internet stocks, passing through British railways and the South Sea, the history of markets is peppered with moments when prices lost all contact with reality. Why does it happen? Why do intelligent people, again and again, buy things at absurd prices convinced they'll keep going up? And why, despite knowing the history, do we keep falling into the same trap? Throughout this season we've explored how markets work. Supply and demand set prices. Prices transmit signals. Competition disciplines participants. But there are moments when all of that seems to stop working. Moments when prices climb and climb with nothing to justify them. Moments when reason yields to euphoria. Today we close the season with the most recurrent and most baffling phenomenon in economic history, speculative bubbles. In 1978, the economist Charles Kindleberger published a book that has become the essential reference on the subject, Manias, Panics, and Crashes. Kindleberger, building on the work of economist Hyman Minsky, identified a pattern that repeats in every bubble in history. 5 phases. Always the same. With different protagonists, but the same dynamic. The first phase is displacement. Something changes in the world. A new technology. A discovery. A political reform. Something that creates legitimate new profit opportunities. The second phase is the boom. The first investors make money. A lot of money. Word spreads. More people invest. Prices rise. And because prices rise, more people want to invest, which makes prices rise even more. It's a self-reinforcing cycle. The third phase is euphoria. Everyone is making money. Taxi drivers give investment tips. Newspapers publish stories about people who got rich overnight. Voices warning of danger are ridiculed. This time is different, everyone says. The fourth phase is profit-taking. The most experienced investors start selling. They've seen this before. They know it can't last. Prices stall. The fifth phase is panic. Someone sells, and the price drops. The drop triggers more selling. More selling triggers more drops. The virtuous cycle becomes a vicious one. Those who bought at the end, with borrowed money, are ruined. Kindleberger documented this pattern across dozens of episodes over 4 centuries. And his conclusion was that bubbles aren't aberrations. They're a recurring feature of markets. Let's go back to Holland in 1637. Tulips had arrived in Europe from the Ottoman Empire in the late 16th century. The Dutch fell in love with them. They were exotic, beautiful, and some varieties were extremely rare. The displacement was real. Rare tulips were genuinely scarce. Some varieties with unusual color patterns were caused by a virus that affected the bulbs, making reproduction unpredictable. Supply was truly limited. But starting in 1634, something changed. People stopped buying tulips to enjoy them and started buying them to resell. Futures contracts on bulbs multiplied. They were traded in taverns, without regulation, sometimes without the bulbs physically existing. Prices multiplied 20-fold between November 1636 and February 1637. Artisans, servants, sailors, everyone invested. Many borrowed money to buy bulbs. And suddenly, in the first week of February, the market collapsed. Nobody knows exactly what triggered it. But once selling started, there was no stopping it. There's an important nuance here. Some historians, like in Goldgar, have argued that tulip mania was less catastrophic than legend has it. That losses were concentrated among a relatively small group of speculators. That the Dutch economy didn't collapse. Others, like Peter Garber, have suggested that some of the high prices were justified by the genuine rarity of certain varieties. The debate continues. But what nobody disputes is that tulip mania established the pattern that would repeat again and again. In 1720, the South Sea Company, a British firm that held the monopoly on trade with South America, hatched an extraordinary scheme. It offered to absorb the British national debt. Government bondholders would exchange their bonds for company shares. The plan sparked a speculative fever. Shares climbed from £128 in January to over £1,000 in July. All of London's society invested. Servants, aristocrats, clergymen. Isaac Newton, the most brilliant scientist of his age, also invested. He bought shares early, sold them at a profit, and then, watching them keep rising, bought back in. This time near the peak. When the bubble burst in September of 1720, Newton lost £20,000. An enormous fortune. He reportedly commented, "I can calculate the motion of heavenly bodies, but not the madness of people." The South Sea bubble was more destructive than tulip mania. It ruined thousands of families. It triggered a political crisis. And it led the British Parliament to pass the Bubble Act, which restricted the creation of joint stock companies for over a century. In the 1840s, Britain experienced another bubble. This time, the displacement was technological, the railway. The railway was a real revolution. It transformed transportation, connected cities, reduced costs. The first lines generated enormous profits. Investors piled in. At the peak of the mania, Parliament approved hundreds of railway projects. Lines were planned everywhere, many between tiny villages without enough traffic to justify them. The capital invested exceeded the equivalent of the country's gross domestic product. When the bubble burst in 1845, thousands of investors were ruined. Many lines were never built. Others were built and went bankrupt. But here's the interesting part. Unlike tulips, Railway Mania left something behind. A rail network that transformed the British economy. The lines that survived catapulted the Industrial Revolution. Technology bubbles have a peculiar characteristic: the euphoria is exaggerated, but the underlying technology is real. The bubble destroys fortunes, but the infrastructure it finances often has lasting value. In the late 90s, the internet was the new revolution. And Wall Street went crazy. Companies that barely had revenue went public and their valuations skyrocketed in days. Pets.com, an online pet food store, spent millions on advertising, including a Super Bowl commercial. It never turned a profit. It closed in less than a year. Webvan, a grocery delivery service, raised more than $800 million before going bankrupt. Boo.com, an online fashion retailer, burned through $135 million in 18 months. The Nasdaq index, which groups technology companies, went from 1,000 points in 1995 to over 5,000 in March of 2000. It multiplied fivefold in 5 years. And then it popped. In 2 years, the Nasdaq lost nearly 80% of its value. Trillions of dollars evaporated. Companies that had been Wall Street darlings ceased to exist. But, just like with the railways, the technology was real. The internet didn't disappear. Amazon, which went from $107 per share to $7 during the crash, survived and became one of the most valuable companies in the world. Google, founded during the bubble, transformed global information. The fiber optic cable laid during the euphoria became the infrastructure of the digital age. The bubble destroyed fortunes. But the revolution that caused it was genuine. Here is where economists profoundly disagree. The efficient market hypothesis, developed by Eugene Fama, holds that prices always reflect all available information. If this is true, bubbles are only identifiable in hindsight. In the moment, high prices might be justified by legitimate expectations. What we call a bubble might simply be an adjustment of expectations that turned out to be wrong. On the opposite side, Robert Shiller, who coined the term irrational exuberance, argues that markets are profoundly influenced by human emotions. Fear, greed, herd behavior, the tendency to extrapolate the recent past into the future. Shiller predicted both the dot-com bubble and the 2008 housing bubble. Fama and Shiller shared the Nobel Prize in Economics in 2013, despite defending nearly opposite positions. The Nobel Committee, in an act of intellectual honesty, acknowledged that the debate is unresolved. What does seem clear is that bubbles share common elements. Abundant credit that allows buying with borrowed money. A convincing narrative that justifies high prices. And a moment when the narrative breaks and reality asserts itself. There's an explanation for bubbles that is brutally simple and probably quite accurate. It's called the greater fool theory. It says that during a bubble, people don't buy because they believe the price is fair. They buy because they believe they can sell to someone even more willing to pay a higher price. You don't need to be convinced a tulip is worth a house. You just need to believe there's someone more foolish than you willing to buy it. The game works as long as there's a greater fool available. When the fools run out, the last buyer is left holding the tulip and the loss. It's a game of musical chairs where nobody knows when the music will stop. And the music always stops. Bubbles aren't just historical entertainment. Their consequences are paid by real people. When the Spanish housing bubble burst starting in 2008, hundreds of thousands of families lost their homes. People who had bought apartments with mortgages they couldn't afford, convinced that prices could only go up. People whom banks had lent money to without adequately verifying whether they could repay. Developers went bankrupt. Banks teetered. Unemployment in Spain exceeded 25%. An entire generation of young people faced a devastated labor market. Bubbles have winners and losers. Those who sell in time make fortunes. Those who buy at the end lose everything. And typically, those who sell in time are professional investors with information and experience, while those who buy at the end are small savers who got in when everyone was talking about how easy it was to make money. Bubbles are a machine for transferring wealth from those who arrive late to those who arrive early. And those who arrive late tend to be the ones who can least afford it. 3 ideas to take away from this episode. First, speculative bubbles follow a pattern identified by Kindleberger-Minsky. Displacement, boom, euphoria, profit-taking, panic. From Dutch tulips to the dot-coms, the dynamic is the same. Second, technology bubbles have a special characteristic. The euphoria is exaggerated, but the underlying technology is real. Railways and the internet survived their respective bubbles and transformed the world. Third, economists debate whether bubbles are irrational. Fama argues markets are efficient. Shiller argues emotions distort prices. The debate is unresolved. What is clear is that bubbles are a recurring phenomenon, not an anomaly. Throughout this season, we've explored how markets work from the broadest perspective. The invisible hand. Supply and demand. Prices as signals. Competition and monopoly. The stock market, bonds, and bubbles. But every market is made up of individual decisions. A consumer choosing between 2 products. A firm deciding how much to produce. A worker negotiating their salary. In Season 6, we change the lens. We leave the big picture and zoom in on the decisions of specific people and companies. Welcome to Microeconomics.